You're listening to New Retirement Radio, brought to you by the team at Prout Financial Design.
Hello, I'm your host, Certified Financial Planner, Dennis Prout.
I'm Heidi Cartwright, Financial Advisor and RICP.
Advisors associated with Prout Financial Design may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of Integrated Partners, a registered investment advisor, or 2. Solely investment advisor representatives of Integrated Partners, a registered investment advisor and not affiliated with LPL Financial. Investment advice offered through Integrated Partners, a registered investment advisor. Integrated Partners and Prout Financial Design are separate entities from LPL Financial. Dennis Prout and Nathan Prout are solely investment advisor representatives of Integrated Partners and are not affiliated with LPL Financial. The opinions voiced in this show program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional before making a decision.
WTCM News Talk 580. It's a Thursday. That means time for New Retirement Radio with Prout Financial Design in Traverse City. Joining us today, Mr. Dennis Prout. Good morning, sir.
It's good to be here in the middle of our rain event, the 1 week rain.
The rain event.
Rebuilding our aquifers. It's great to be here. Excuse me, just had to take the gum out of my mouth. Don't talk with gum in your mouth. We've got the whole band here, as you can probably tell, and I'm a bit excited. Well, it's great to have you here with us. Welcome. Thursday morning, 10:23. If you are listening to the rebroadcast on Saturday, it is a rebroadcast. But because it is today, Thursday, of course, you can call and or text us if you have a receptus you'd like us to answer.
And you can do that with one handy number, 231 area code. Call or text your questions, 947-0023, 947-0023.
Yeah, because the Tigers aren't in the playoffs, you have plenty of time to listen to us, right?
Still too soon.
Nice. No one's laughing. Well, we have Heidi Cartwright joining us here. Good morning, Heidi.
Good morning, Dennis. It's my pleasure to be here this morning.
Great. It's great to have you here. Our own RICP, Master Lead Advisor, Director of Operations. Thanks for joining us, Heidi. And then Nathan Prout, too. Nathan over here, our Master Lead Advisor, and also joining us, Nathan Prout, which I just said, repeating myself. Just so
That's a specific designation. It's great to be here. Yeah.
It's great to have you here. And then Beth Shire over there. Good morning, Beth, our own Director of Marketing.
Good morning, Dennis.
Yay.
Yeah, it works.
Now,
testing.
Who does what? Yes.
No, it's great to be here and to echo you, Dennis. It's great to have the band back together again. It's been a couple weeks.
Yes, it has.
Even our bass players with us, which is the most important piece of work in the band. We're going to be listening later to Nat King Cole and hopefully Joe Satriani. Hopefully.
We've got some Joe queued up here somewhere.
Summer Song is the name of that one, Ron, just, so you're ready.
By Satriani?
Yeah. It's really got a great intro. I confess my addictions. Well, it is great to be here. Oh, my gosh, there is so much going on, but I digress. First off, well, I'm going to be talking about a bear market survival kit, and then to whipsaw everyone just when we thought we could trust someone, we're also going to talk about the 5 forces
that could stimulate the U.S. economy.
See, so bear market survival. Why would we want to talk about that? The market's just continuing to go up and up and up. Yes, but forewarned is forearmed, is it not? And also, Sun Tzu, The Art of War, in that book, he said, victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. So how do we prep for such a digressional downturn in the markets, which could possibly mirror gold and silver correcting, albeit briefly perhaps. We'll see. Then Nathan's also going to discuss year-end planning things for retirement accounts.
Yeah.
Year-end planning, tax planning.
Mm-hmm.
Can you believe we're 2 months rather, and a week away from the end of the year? 2 months. We're almost where we are on the cusp of November 1st, are we not?
Everything's going to speed up.
It is.
Yeah.
All right. Here we go. Let's dive in. When volatility is high, interest in survival strategies normally spikes. But the better time to build those strategies isn't when fear is peaking. It's now, while clarity and confidence are relatively intact. Now, this is written by Mr. Ted Neild. I'm not quite sure how to pronounce his last name, CFA. He is with Gresham Partners, for background. In that spirit, we're revisiting some foundational principles of long-term investing. These ideas may sound familiar. That's the point. They are timeless, but also easy to forget just when they're most essential. Great point here. One common misperception about bear market investing is that success requires active corrections and portfolio manipulations amid the bear market. To me, it's like trying to fix the roof in the middle of a downpour. Who does that? Only if it's like critical, right? If your house is flowing water inside, you might hire someone and or get out there yourself to try to at least put a Band-Aid on it. In fact, the most important key to success has nothing to do with the bear market itself. It's how one's portfolio is positioned entering the bear market. Thank you very much. Not having all those eggs into one basket. Yes, thank you, Ron. A common practice in portfolio construction is to build asset allocations based on backward-looking statistical simplifications instead of saying, what's our opportunity in the future, given that prices are even moderate right now in some sectors of the economy, which they are.
In some sectors, yes.
In some sectors. Dennis, could you just cut to the chase and tell us what you're buying? No. In our experience, these allocations often fail to provide sufficient downside protection, surprise investor with larger than expected losses, and lead to fearful responses. That's usually the problem, surprise. With a well-crafted portfolio, investors should feel confident riding through a difficult period and rebalancing their portfolios in a systematic manner. Do any of us feel confident when the rain is falling outside? I mean, sometimes it's just tough. This runs counter to our natural human response because it requires investors like us and you to add to areas of the portfolio that have experienced the largest declines and sell assets that have been relatively safe havens. Why are you selling, XYZ? It's done so well. Well, yes, but the prices are in the stratosphere now. Perhaps it's time to reallocate some.
Sell high.
Yes. Or even sell near the high. Was there a point or a question that you had had previously there, Ron? We kind of skipped by that.
No, I don't have a question.
No,
I'm just
okay.
following along.
All right. Confidence that your portfolio is appropriately constructed gives you the ability to withstand the inevitable bear market and is central to long-term investment success. Yes, thank you very much. So having some investments that look just like a dog right now, a dog. That is the Warren Buffett strategy. Be greedy when others are fearful, and fearful when others are greedy. Are others greedy right now? The markets are really quite high. They're really quite high in terms of valuation, in the AI sector especially. Yes. Can we name a few companies? Yes, we can. Apple, Google, etc., etc. That's Yul Brynner. Okay, just for those
NVIDIA.
wondering. And NVIDIA.
NVIDIA.
Great companies all. Truly great companies, but their valuations are really quite high. Mm-hmm. So, human nature is a horrible guide. Now, this article, I wish I was telling people in the leadership team here that I wish I had a whole hour to go over this, but I don't. So I'm having to really, really shorten it because it's just loaded. Markets move in cycles. Boom followed by bust followed by boom should be considered normal. What is not normal is the most recent 15 years of nearly uninterrupted gains. Now, I wrote down the price of the Dow 15 years ago, Ron. Any guesses?
That'd be 2010.
2010.
The Dow now for
is
reference.
about 45, 46, depending on the hour of the day.
And we've got 46 and a half, we'll
46.5.
call it. So 15 years ago, I will say 28.
Yeah, that's a great guess. But you missed it by a mile, man.
I missed it by a mile.
Sorry. Lower.
Lower. 16.
Lower yet.
We're at 45 now, and 15 years
It's
ago.
eye-popping what it was.
What was it?
11,000 on the Dow.
So up 400% roughly.
Yes.
Wow.
4 times. For those mathematically challenged folks there. 4 times. So a lot of money has been made in this market. For perspective's sake, maybe why Buffett lightened up a bit the beginning of this year. So far he's been dead wrong, but eventually he may be correct. Maybe he's got too much cash. That's another argument. So prospect theory. Holding investments that decline in price is unpleasant, and it turns out disproportionately unpleasant when compared to the enjoyment of portfolio gains. Everyone with me? We feel it much greater when we lose versus when we gain. Long story short, in 1979, Daniel Kahneman and Amos Tversky accurately captured the asymmetric relationship that we have between losses and gains in this groundbreaking paper. Prospect theory states that an individual's fear of losses is much greater than the joy of gains. The magnitude of this effect varies by individual, but is nearly universal and thought to have evolved from human survival instincts. So sometimes you just have to set your opinions aside and realize that nothing great comes without sometimes pain. Risk is actually highest when everything seems to be going well and the market is going up and getting more expensive. In contrast, the panic experienced deep in a bear market or recession often provides the best investment opportunities. Who wanted to buy this early spring in April when the markets were down as much as they were? It was tough to find. You mean I should buy XYZ right now? Strong consideration. Yes.
I was looking at the Dow all time after you quizzed me there. The graph is up there. And the big drop off, well, it's a steady climb since 2010, as you said, but little notable drop off in February of 2020. I thought, what was that? Well, it was COVID.
It was.
It's more than doubled since then, the Dow, value of the Dow.
Isn't that crazy?
Since that big drop off 5 years ago.
That April was the biggest month we'd had in 30 years. The biggest 1 month gain after that significant decline. So you say, what does that mean? Market timing doesn't work. As the old saying goes, there are only 2 types of people when it comes to market timing: people who cannot do it and people who have not yet realized that they can't do it.
So basically, you just can't do it.
You can't do it. Because you may have made a great decision to get out, but getting back in, there's usually one part of it missing. It's either you fail on the one end and win on the other, or you lose on both ends because you got out and then you're so fearful that you can't get back in again.
So you have to be successful twice.
Right, which is
More
usually
difficult.
Very difficult. And it just doesn't work. And then next, ignore expert predictions. Jeff Sommer, writing in the New York Times, noted that the median Wall Street forecast from 2000 through 2020, speaking of 2020, there you go, Ron, missed its target by an average of almost 13 percentage points, which was more than double the actual average performance of the stock market itself. Even worse, during those 20 years, the median Wall Street prediction was never negative, Yet the markets were down 6 of those years. Adding insult to injury.
2020.
Yes, thank you. She almost fit herself in there. As John Kenneth Galbraith once famously said, the only function of economic forecasting is to make astrology look respectable. The most recent example of horrendous forecasting was in 2020. Finally getting to your point here, Ron.
2020.
Thank you so much. During the roller coaster ride at the beginning of the COVID pandemic, the equity market experienced its sharpest decline in history, dropping nearly 35% in the first few months of the year. So what am I saying through all of this? While it's fun to exult in your gains, are you too much allocated to those types of gain companies? Do you have too much in AI now? Can you have too much in AI? Yes. That growth sector may not provide the returns you've been expecting, and or the market in general may experience lesser gains. Gentleman I was speaking to over the weekend said, well, I made 17% in my 401k. And I looked at him and I said, I sure hope you don't expect those kinds of return in the future. Oh, no, I don't expect those. Well, I understand. But keep in mind, this is rather an anomaly right now going on. We're in an anomalous time. Is that a word? I think so.
Anomalous.
Or you just invented it.
Yeah, well, I guess our listeners will have to tell us.
It's where the naval headquarters is, isn't it? in Maryland there?
Yeah. It's anomalous Maryland. In April, when the effects of the pandemic were becoming clear, April of 2020, a Bloomberg survey found that forecasters' consensus predicted that the S&P 500 index, 500 companies followed by the S&P, or followed through S&P, expected the S&P 500 index to finish the year down 11%. We know that this was opposite of what actually happened because the market rebounded more than 60% from its lows to close up nearly 20%. 20% up. So they were only off by 31%. Not bad. Yet Wall Street continues to issue erroneous predictions. Why? First, there's no accountability for the lack of accuracy because very few remember their predictions. They're so dead wrong, often. What should we do, lastly, and most importantly, what should you do? Number one, unpredictable market movements, unanticipated volatility, and unexpected bear markets are the cost of being an investor. Underline that in your mind, cost of being an investor. I likened it this morning in speaking with Keegan. I said to Keegan, is learning, does that take a price? We are talking about how much there is to learn, study. Yes, there is a price. But will you eventually enjoy the benefits? Well, obviously we hope so. We can't guarantee it. But having made the investment, your chances of getting the return increase exponentially.
If an investor saving for the retirement account says, I'm really leery, I don't like stocks, I don't want, or what are there options for people who want to invest for their future outside of the stock market, especially for retirement?
Yes.
Bonds, but besides stocks and bonds.
Yes.
There's stocks and bonds, there's annuities, there's CDs, there's a lot of different types of investment products out there that people can utilize if they want to stay away from a certain product. There's alternatives.
There's also ETFs that help control losses.
What's that?
So, an exchange-traded fund, if you will. So these can help control losses, but also help you get some exposure within very carefully controlled limits within the portfolios themselves and or really taking into account your own risk tolerance. That's key.
Ready for a question?
Yes.
From the text line, how many years of income would you suggest I transfer from my IRA to a conservative fund to hedge a potential downturn? Currently, I have 1.2 million, 66 years old, was planning on starting Social Security at 68. So they want to, how much out of the IRA into a conservative fund?
It's a great question. So right within the IRA, you can set a specific area of income that you want to draw from a much more conservative option within the IRA. Perhaps it's a short-term bond fund, short-term tips fund, several come to my mind. But think about it in terms of how much you're drawing, how soon you're going to draw it, number two, and your own risk tolerance, just a few. But generally, what would you say, Heidi?
I would agree with you, Dennis. I would focus a lot on the timeline you have in front of you. What do you think you would potentially take out of those funds in the next 2 to 3 years? And those you definitely want to protect with a more conservative investment. But you also want to keep your eye on the long-term road in front of you, so you want to have a portion of your portfolio invested for those long-term gains. But really look at your timeline and the amount you're taking out in any period of time and protect that future income path.
The most interesting thing I saw was an article a couple of weeks ago in the Wall Street Journal where this prof, I forget from what college it was saying that he was proposing that people should draw from Social Security earlier, just because they were more reluctant to draw from their portfolio given the studies that he had seen. And I thought, I had never seen that, and I actually wrote him back, although I haven't heard from him. He has no idea who I am. But I said, what a great point. It's not been considered. So to the extent that you need guaranteed income, consider perhaps drawing from Social Security earlier and or drawing from your guaranteed sources as a part of this. But the other part of that, too, I would say, even thirdly, sometimes you almost have to make yourself take that income. So setting it up for income, being disciplined about drawing a fixed amount that's within your spending needs, if you will, with considering a lot of other areas, but generally 2 to 3 years income within the IRA, so it's not taxable, having repositioned those assets to draw that income, so then you don't have to worry about what the market has done to your portfolio when you're drawing that income.
So what portion of his portfolio, you say about 2 to 3 years of income generally?
Yes, you
okay.
bet. Yep.
There's a couple more here, maybe. Let's see. I still hope the names. Nope, that's not it. That's an incomplete sentence. I just want to get this. Would Dennis speak about gold as an investment?
Yeah, gold is a hedge and a defensive mechanism. So Beth has got some great stats on that, what Bank of America is saying about it. It's certainly been in the news, but it was overbought. According to the RSI, the Relative Strength Index, overbought. And I'd been mentioning to clients, although we really hadn't, I don't know whether we mentioned it on the radio or not. Frankly, I think it's a short-term situation, but who knows? We don't know, except that it has accelerated to crazy prices we're seeing in gold and silver. But there are reasons at the same time for that climb. Our government debt, central banks buying, the fear index. So increasing somewhat. So all of those are features related to the price of gold. Is it locked in? By no means. It's among the most volatile assets to own right now, period. So enter very cautiously, carefully, and as educationally as you can. And that's as much as I can say in the radio. So a couple other points, and then we'll take a break. Next, in what should you do? Adopt a long-term perspective and stick with your investment strategy unless you need to make some changes as you go, all right? Structure, next. Structure all-weather portfolios that will share the market's upside and preserve value when the market is down, which we've referenced earlier. Lastly, markets don't ring a bell at the top or bottom. A sound, thoughtfully constructed portfolio allows you and me to endure downturns and take advantage of inevitable dislocations. So recognizing that part of the price of investing is surviving the downturns. And we would expect those to continue and somewhat mightily in the future here.
We
Yes,
do have
sir.
a question, but it might be one that you can't answer on the radio.
Sure.
Somebody said, do you think 2 years of CDs and cash for expected IRA draws is sufficient? Or, with the 37% increase in the S&P last 2 years, would 3 years be advisable?
There's so much that goes more into that. When we get to that level, to me, I'm just like, well, I need to know. I have like 5 questions in my mind. So I would recommend that maybe he comes in and meet with us, and we could look at that situation and know more information before making a general yes or no to that.
I think there are probably a lot. You guys have a lot of compliance and rules and
Oh, yes.
regulations, and just common sense says you don't want to advise somebody on the radio and without knowing the full story.
I mean,
I would
there's so
say
many things.
it's a great place to start, even considering that. How do we approach this kind of these price this price situation and how this market has come up so much? How do we take some profits and perhaps, given where taxes are this year, considering paying, say this quietly, paying more in tax may be a great strategy this year.
Maybe.
Say that quietly. So while all of us hate
If
taxes,
we talk quietly enough, compliance can't hear us.
yeah, that too, exactly.
The next segment will be whisper questions.
Yeah,
So were you saying earlier, just to clarify,
That's great.
the example, the guy had 1.2 mil. He said, how much should I put into something more conservative? And you said, so suppose he says, I need $300,000 for the next 3, 4, 5 years. So put that into something conservative, and then that's where you draw your money from. Meanwhile, the rest of your money is exposed to it's a little more risky, but you don't have to worry about that's going to go down maybe, but it's going to go up and down. So you draw from the conservative pile is what you're saying.
fundamentally, you can let it ride, and
Okay.
your comfort level generally should be greater. Now, we can never say it will be.
Yep.
But yes, then you can allow. Now, what's going on when the markets come down? Of course, what are money managers doing with their salt? They're buying, just as you would if you had the knowledge, the experience, and the fortitude to withstand those kinds of things. And we all get being an expert. The plumber who comes in and listens to your faucet for 2 seconds almost knows, yeah, you got a problem in there. I can take that apart and have it fixed in 30 minutes. Whatever it is. So that expertise is endemic, or tends to be, to those who are involved in that work on a daily basis. That's why you pay experts. Good people tend to do good things.
And what you're primarily trying to avoid is accelerated attrition of the portfolio in a down market. That's why you isolate some of that portfolio into a conservative investment that will not be on that downward slide. So you have to sell more and more to get that dollar amount every month out of the portfolio, because when the market recovers, that's where it really hurts, because you've taken an accelerated amount during the downturn.
So you don't want to leave it all exposed, and you don't want it all protected in very conservative investments.
Exactly, and that's
Okay.
why you should probably go to a financial advisor to help you figure that out.
Like Prout. Yeah, I mean, being able to account to someone is a huge part of it. Having those active conversations where, you're able to say it out loud. Then your own brain can say, yeah, I probably wasn't making a whole lot of sense there. Whatever that is. Having those active conversations. Heidi, so the 5 forces that could stimulate the U.S. economy, please.
Yes, and this is an article that comes to us from Capital Group or American Funds. It's written by 4 portfolio managers that each have about 25 years of experience in their fields. Cheryl Frank, Damian McCain, Britain Azez, and Mark Casey. I hope that's how you pronounce all their names correctly.
Very good.
So slowing job growth and consumer spending patterns suggest the economy is weakening. However, there are reasons for optimism. From the passage of the tax bill to declining interest rates, there is less uncertainty on many fronts compared with earlier this year. And here are the 5 forces that they think lead towards optimism for the future. The first one is the Fed starts rate cutting cycle. The Federal Reserve's latest rate cut arrived at a moment of economic softness, namely sluggish job growth. Officials guided additional cuts through 2028. So when they say officials guided additional cuts, what they're saying there in that comment section that they have after they announce something, they're giving indications that they might continue this pattern, but they're talking about it, really, is what they're saying.
The betting markets are predicting both November and December rates will come down, so, no surprises.
Yep. Rate cuts usually lead to higher company spending and hiring and more sales of big ticket items such as cars and homes. There's a long list of companies waiting for rates to drop, especially those tied to the housing market. They also observed that markets have rewarded investors when rate cuts happen outside of a recession. On average, the S&P 500 index returns 27.9% in that case. So far this year, the Treasury has declined over a half a point to 4.13 on October 8th of this year. So let's move on to the second force.
Sorry, the Treasury, what has declined by 0.5%?
The 10-year Treasury.
The 10-year Treasury. Thank you. So that's huge.
Just to be clear.
A great indicator of current interest rates, the 10-year Treasury rate. That's why Heidi referenced it. Thank you. Go ahead. Sorry.
So the second force we're moving on to, the tax bill, functions as a massive stimulus check. So a notable feature of the One Big Beautiful Bill Act, otherwise known as is the inclusion of a retroactive tax cut for 2025, with refunds to taxpayers expected in early 2026.
Those baby boomers
I
at it
didn't hear
again,
about the retroactive tax cuts, though. That's interesting.
Isn't it?
Well, it's for 2025, so this was passed in the middle of 2025. It's going to be for the whole year.
Ron,
okay.
Think about this. When you get to be over age 65, you'll be able to take advantage of this tax cut.
But it's not retroactive to last year, right? It takes place in 2025. So when you go and do your taxes by April of 2016, it's for this tax year.
Right.
Yeah.
2016. You're a little behind there, Ron.
2026. Thank you, Nathan.
Now we're all confused.
Thank you for noticing that. Okay, what?
So exemptions for overtime
Refunds.
and tips translate to unusually large tax refunds totaling over $200 billion in early 2026. It could function as a massive stimulus check. The one-time cash infusion may serve as a powerful psychological boost to consumer confidence and provide some relief to the tariff-related inflation.
Is there Corvette in your future, Ron? That's what I want to know.
No.
Just curious.
All right. The bill also favors companies that invest in the U.S. by lowering their taxable income. Specifically, companies can quickly expense spending on research and development, capital investments, and new factories. As a result, technology and defense companies may see a boost in free cash flow. The third force, deregulation. A deregulatory environment could benefit some companies, including those left out of the artificial intelligence boom. Many businesses not on the cutting edge of technology have been left behind. Broadly speaking, companies in energy, industrials, and telecommunication sectors could be helped by deregulation. Investors are also closely tracking bank deregulation since it could increase lending activity across industries, a potential tailwind for the economy. With the deregulation push by the U.S. administration, companies may feel less constrained in investment decisions. Which leads us to the force number 4, which is rising defense budgets are a long-term tailwind. As NATO partners boost defense budgets, demand for products across a range of industries should jump. In June, NATO allies committed to increasing defense spending from 2 to 5% of GDP by 2035, a dramatic shift that's reflective of a mounting geopolitical tension as tariffs threaten supply chains and strain alliances. So Germany in particular has taken the lead. It previously disclosed aggressive fiscal stimulus focused primarily on defense and infrastructure. Rising defense budgets represent a long-term tailwind for many U.S. companies since the majority of advanced defense systems are made in America.
Huge demand in the future. Just
Right.
huge. I was reading this morning about this significant increase in demand for defense companies. I think some of them will struggle to supply all the requirements, all the demand.
And the last force is AI. The author expects widespread adoption of AI across industries, which could drive productivity gains and innovation. So those are the 5 forces.
We're only on the edge of seeing what AI is going to do. That's for sure. Yes, Ron.
He said that article, as of June 30th, 2025, a couple of months ago, technology spending in AI includes research and development, and data centers accounted for about 7.5% of U.S. GDP,
Yes,
surpassing the dot-com era peak. I didn't realize AI is that huge.
it's huge.
I mean, they're talking about using it from. I mean, I left the book at home this morning. The AI, how to as leaders can take advantage of AI. So there's we're just at the beginnings of seeing what it's going to do in terms of allowing us to better track what's happening, to use this intelligence when it's requested specifically and knowledgeably to enhance our lives and our businesses. So it'll be huge. So, Nathan, year-end tax planning.
That's right. Out with the old, in with the new. So this comes to us from one of our more enjoyable business partners, Ed Slott. So fall is in the air, and the final few months of 2025 are upon us. This is a critical time for proactive retirement account planning. So the recently passed One Big Beautiful Bill Act, the Secure Act, and its offspring Secure 2.0 Act, as well as thousands of pages of IRS regulations, have all added to the mix of already complicated deadlines. And the changes keep coming. Don't worry.
There'll be more.
There'll be more. So to kick things off, required minimum distributions. So any IRA owner who is older than age 73 this year, and you may have remembered when it used to be 70 and a half, and then it was like 72, and then it was 73, and now some people it'll be 75. I believe that was anybody born after 1960.
That's
Yes.
correct.
Yeah. So, moving target, if you will. But anybody who is 73 this year must take a 2025 RMD by December 31st, 2025. Roth IRA owners, on the other hand, never have to take RMDs. Employees in 401k and other employer plans are not required to take a 2025 RMD if they qualify for the still working exception.
Circle the word if.
If, yeah. And they can't be more than a 5% owner of that company either. So there's a couple of things with that exception to pay attention to. So those who do not qualify must take their 2025 RMD from pre-tax accounts, but not Roth 401k accounts, by December 31st. So Roth conversions after the One Big Beautiful Bill, to qualify as a 2025 Roth conversion, funds must leave the IRA or company plan by December 31st of this year. There's no such thing as a prior year conversion.
So, unlike your contribution that you might decide to make until April 15th, which you can make for the previous year, you can't do a conversion for the previous year.
That is correct. Yeah. It is certainly a good idea to an extent, to wait until later in the year before converting in order to get a better picture of this year's tax situation. But do not wait too long, because some IRA custodians will not process conversions for the year after a specific date. And I'll highlight that because they will pay more attention to RMDs as well than they will conversions. A lot of the custodians we work with say December 10th, December 15th, you're really starting to push it because everybody waits till the end of the year for the most part to do their RMDs.
So don't wait for the rush and don't get in line at noon for lunch, okay?
On December 31st.
Right.
Just like you might not want to make your previous year IRA contributions on the tax deadline day. It just might not be a great idea. So, the One Big Beautiful Bill Act brought good news to those looking to convert to Roth IRAs by making permanent the reduced federal income tax rates enacted in the Tax Cuts and Jobs Act of 2017.
Now, this is a huge deal. This is a big tax cut for anyone over 65 and within certain income limits. Go ahead, Nathan.
Yeah. So the arrival of that bill has also added some new considerations for 25 conversions. Most older individuals will want to take advantage of the new $6,000 deduction for seniors, which the bill makes effective for 2025 through 2028. Roth conversions can push clients over the extra $6,000 senior deduction phase-outs, though, so watch out for that. And those phase-outs are $75,000 to $175,000 for single, and $150,000 to $250,000 for married filing jointly. However, taxpayers with income below those limits will be in relatively low tax brackets, so the potential loss of the senior deduction will not be significant. In the long run, a Roth conversion might still be worth it.
Especially for those in the lower income brackets and for those, again, over age 65. You just got, if you're in those brackets and you're married, another $12,000 in deductions for 25. That's a huge cut in tax. Yes.
That's right. And do you have some stats for us today, Beth?
I do, yeah. That was a quick transition.
Yeah,
I wasn't
let's do
ready
it.
for that.
We're in
Here
a
we
time
go.
crunch here.
Sure,
You
yeah.
bet.
So, according to Reuters, Bank of America raised its 26 gold forecast to $5,000 an ounce, and its silver forecast to $65 an ounce. This comes after gold broke $4,000 an ounce for the first time in October of this year.
What's gold? 6,000, they said?
They're going to raise
4,000. They raised it to
Five. Yeah.
5,000.
By when?
for next year,
Oh,
for
for next year,
26.
26.
Yeah.
And silver, it's about $50 an ounce right now, as of today, if you will.
Mm-hmm.
And they predicted what price for that?
65.
65. So a 30% increase rather in the price of silver, according to Bank of America, in some point in 26.
So
Yes.
they still see some room there.
Oh yeah, they still see some room for volatility too. Lots
Yes,
of
indeed.
volatility. Yes.
Do we have time for one more?
Yes.
Okay. I'll hurry. The Federal Aviation Administration delayed 22,000 flights between Monday, October 6th and Sunday, October 12th. This is due to staffing issues because of the government shutdown. Nearly 13,000 air traffic controllers and 50,000 TSA agents are still expected to work during the shutdowns despite receiving partial or no pay.
All right. And we had one last text here for you guys, a comment, or actually two. It says, Ed Sullivan would say, really great show featuring Dennis Prout and the Retirement Planners.
I love it.
Nice.
Thanks for the good word, man.
So
What
there we go.
fun today. Appreciate our listeners. As always, thank you for listening. You bet.
All right. Prout Financial Design, located in Traverse City, Michigan, 231 area code 947-3992. On the web at proutfinancialdesign.com. Dennis, Heidi, Nathan, and Beth will be back. Thank you all.
Thanks,
Thank you,
Ron.
Ron.
Appreciate it, Ron.
Thank you.